What's up, good people? How you doing? Welcome back to Stock Up with Larry Jones. Go ahead and hit the like, subscribe, and the notification bell. Let's see if we can just dive right into some stuff on this Sunday afternoon. Some things that's going to prepare us not just for this upcoming week, but this upcoming period in the market, right? There's a lot of crazy volatile things going on in the market, but like we say here at Stock Up, we not scared, we're prepared. All right, so for those of you that was looking at my video from Friday, let's just go right into it, good people. So Friday I said this as the market was up almost 200 points. Be careful about the last hour, it being Friday, with people not trusting Putin, and be careful, just because the market is green right now doesn't mean, so the Dow was green, the S&P, I believe it was flat. Don't think that this means that it's going to end green. So I said anything could happen closer towards closing bell, and we all see what happened. Just pull up the Dow, the S&P. Literally at closing bell, it curved and went down. All right. So at that time that the president was speaking, the market was actually going up, and it went up. It was like positive 200 points. It was actually earlier that day, it was positive 400 points. And then it tanked the very end of the market. And that's what I want you guys to be aware of during this period on Fridays. So now, do you run in fear because of that? No. What I do is that's when I buy my $5 a day. I buy it Friday evenings, the last half hour of the market. So that's when I make my purchases for my $5 a day, $1 million cup of coffee in all three of my portfolios. Okay. Yet again, I'm going to leave a video in the box up here at the end. And I want you guys to look at that if you want to follow the Larry Jones $5 a day challenge. It is the way to build generational wealth. So now let's talk about the big R word, recession. Here's some things that I want you to know about a recession. Most recessions that happen, I remember 2007, 2008 to 2009, that recession. I remember it like it was yesterday, because it was the first time I made the most amount of money in the stock market. Okay, I just want to say that again. It was the time that I made the most amount of money, the most gains in the stock market was in 2008 during the recession. The second time I made the most money in the stock market was 2020, COVID. What is that telling you, good people? Use me as a case study example. There is money to be made in times of fear. So that's why I say we are not scared, we are prepared. Anything I say is not a suggestion for you to buy, hold, or sell. So let's talk about what happens when a recession comes. I explained in an earlier video that most recessions last only 11 months. I'm going to show you why, in this video, why we think a recession could be coming. And if it does come, all of the analysts thinks that it may come by the second quarter of next year, 2023, okay? A recession could happen then. All right, so let's look at this, and then I got some good news for you. All right, let's look at this first.
An inverted yield curve occurs during the rare times when short-term interest rates are higher than long-term interest rates. The yield curve is a graph that shows the different interest rates paid by bonds with the same level of risk but different lengths towards maturity. An inverted yield curve slopes downward because short-term interest rates are higher than long-term interest rates. For example, a 3-month Treasury bill may be paying 3%. Meanwhile, a 2-year note is paying 2%, and a 30-year bond may be down around 0.25%. Normally, lenders receive a better yield when they loan money for longer periods of time. When short-term interest rates are higher, it typically results from increased demand for short-term credit. That leads to more demand for short-term debt instruments, like Treasury bills. Inverted yield curves have preceded many United States recessions, and they're used to forecast turning points in the business cycle. For example, in 1980, short-term interest rates climbed to 20%, while long-term rates remain lower. The U.S. equity market collapsed. An inverted yield curve predicts lower interest rates in the future as longer-term bonds see their demand increase, which sends their yields downwards. Yield curves can be normal, flat, or inverted. A normal curve slopes upward, meaning long-term rates are higher than short-term rates. Flat curves reveal interest rates that are about the same.
Let's look at this. The economic indicator that most clearly signals a recession is a real gross domestic product, which is GDP, is gross domestic products, or the goods produced minus the effects of inflation. Get it? All right. Other key indicators include income, employment, manufacturing, and wholesale retail sales. Okay. During a recession, each of these areas experience a decline. Okay. A decline in gross domestic product, right? A decline in employment, manufacturing, and wholesale retail sales. Okay. So you get a decline in that. So what people are earning, the minus inflation. So the cost, the inflation is actually higher than gross domestic product, all right? When inflation is higher than gross domestic product, that's a sign that with the inverted yield curve, right? Those two things are a key sign that a recession is coming. So let's go back to the last big recession, which was December 2007 through June of 2009. Remember, that was one of the worst recessions in our lifetimes, okay? But, well, there was two, but this was by far the worst because I was in the market then. But remember what I said. This is when the first time I made the most money in the stock market, and here's why. So if you look at this, right? So we got this period of 2007 to through 2009, okay? Let's go. And as you can see here, I have the Dow Jones and I have the S&P 500. I'm using these two indicators to show what the stock market did between 2007 and 2009. So here's 2007. Okay, let's get there. Right there, right? So here we are, 2007. As you can see, before 2007 happened, let me blow that up so you guys can see this. So as you can see, before 2007 happened, let's go back to Max. Sorry about that, good people. So as you can see, before 2007 happened, it was going on what? The market was growing, GDP was growing, and it seems like they were going on a bull market. Then the recession happened, which also was the housing market bubble that burst. And so now it went down, right? All the way until what? 2009. What happened in 2009? The recession ended. June 2009. All right, there's June of 2009, okay? So we see that, right? Now, anybody that knows anything about the stock market, was it better to buy it here? Nope. Was it better to buy it here? Nope. The best time to start buying was at the bottom of the recession. Even if we were here, right, and we continue to buy all the way down here and buy back up here through this period, this is what happens afterwards. Okay? So that's what I want to show you guys, that at the bottom of a crash, at the bottom of a correction, and at the bottom of a recession is the absolute best time to buy, especially positions that you're going to be holding long. The problem is no one knows where the bottom is going to be, good people. We don't know. So the best thing to do now that we're in a bear market and then going into a possible recession next year, Q2 2023, is to continue the dollar cost average in, because we're already in this war. And I mean this financial war. We're already in this bear market where there's just seems to be endless bottoms. And the best thing to do during this time is to continue to DCA, dollar cost average through. Okay, so that's what I want to tell you. What could send us into a recession is the Feds not handling the interest rate hikes in the best manner. We call it a smooth landing right now. We want the Feds to have a smooth landing. So there's going to be some months where I believe they're going to have to raise the interest rates more than 0.25%, and then, but not to do it in a way to send us into a early or an indefinite recession. So it all depends on the Fed at this point. I'm sorry to tell you, but that's what we got to see. So, hey, I just wanted to stop in and leave this short one with you. And it's Sunday, good people. So remember, I want you guys to check out all the links below. I have a links for you guys. I have tip ranks if you want to see what the Wall Street analysts say. You guys know I got Webull, and I now have Moomoo. Those are 2 trading platforms. Check those out. They have free stuff that they're going to give you. And then I also have Coinbase down there. I also want to leave by saying, well, I'm not going to say anything. I'm going to let my good friend, Pastor Rick Cochran, leave you with an inspirational message on this Sunday. You had 1 minute to just encourage people out there. What would you tell them?
1 minute. Failing is how you move forward. The more you fail, the more you learn how to advance to the next level, how to get over the things that have held you back, how to get back up. It's the tenacity and the endurance that helps you move to the higher level, move to the next place. Don't be afraid to fail. Failing teaches you everything you need to know. It's actually a better teacher than success. And so learn to fail successfully, but learn to fail forward. That's 1 minute, that's 30 seconds, but it'll change your life.
Pastor Rick Cochran killing it.